Okay, let's go ahead and get started. Welcome to today's webinar. This is session 3 out of 4 pertaining to export financing and risk mitigation. Dr. Ashwin Vibhakar is going to be giving the presentation today, and he's the Joe Ford Professor of Finance at the University of Arkansas in Little Rock, covering currency exchange. Kind of a housekeeping issue here. If you have any questions or issues with your mic or speaker, here's some instructions on how to perhaps rectify that. The main thing I want you to pay attention to is that if you wish to submit comments or questions, you can do so in the question panel on the right-hand side. And today's session is in fact being recorded. This series of webinars is being brought to you and sponsored by the Arkansas Manufacturing Solutions, which is the department of the Arkansas Economic Development Commission. Their mission is to assist manufacturers and maximize enterprise value by assisting with innovation, operational excellence, sustainability, and leadership development. The District Export Council is doing today's webinar, and a little bit about the district export councils. There are 60 of them throughout the United States, and we're charged with encouraging and supporting the export of goods and services that will strengthen individual companies, stimulate U.S. economic growth, and create jobs. Alrighty. Anytime that you're ready, Ashvin, feel free to go ahead and bring up your PowerPoint.
Are you able to see my screen?
I am.
Okay, perfect. Well, good morning, everybody. As Rudy explained, we're going to talk about the exchange rate risk and what it is, understanding of exchange rate risk, and how you try to mitigate that risk. Now, exchange rate risk, simply defined, is you agree to receive foreign currency for your international trade. However, the time period in terms of when you receive money is different. So you may have priced your product based on current exchange rate, and by the time you receive your money, exchange rate could have changed. And what that can lead to is either you make more money or potentially you lose money, and your entire profit that you may have thought you were going to receive could just disappear. And so you're in the business of not playing with exchange rate. Well, you're in the business of making sure that you're making money from your business. Now, exchange rate risk did not exist until after 1972, because pre-1972, there were all different systems in terms of how currency was valued. I'm not going to go through the details of that, but in 1972, particularly the time period between 45 to 72, exchange rate system was dollarized, meaning that dollar was the base against which all the currencies were valued. And that put tremendous pressure on dollar and causing huge demand on dollar, and the value of the dollar increased dramatically. It created tremendous disadvantage to US in terms of international trade. So in 1972, President Nixon abolished the system and declared that US was no longer going to support other currencies in that manner. And that was basically the beginning of variable exchange rate. So exchange rate has become flexible since 1973. So what are the exchange rate system? It is important that if you do trade with other countries, you understand the way exchange rate works. There are 33 large countries which use free floating exchange rate, meaning that the exchange rate will be determined by the market forces, and you have no idea what that rate would be. And what you got to do is make sure that you are managing that risk, based on what we're going to talk about in this particular webinar. There are other countries which use what is called as a managed float. In a managed float, they try to allow market forces to change exchange rate, but the government will intervene in there to make sure that the rate doesn't change too far away from what their targets are. So country like China uses managed float as their way of their RMB in terms of how RMB moves with US dollars. Then there are other countries which use what is called as a peg currency. Basically, they peg their currency to another currency, like particularly US dollar or euro. So for example, if you take Hong Kong dollar is pegged to US dollar, and I think that rate is somewhere in the range of 7.5 plus Hong Kong dollars to 1 US dollar. And that currency is pegged at that rate, and it remains fixed until the government there decides to change to a different number. And then, of course, there are some countries where they have no national currency. So, for example, Panama. Panama uses US dollar. They don't have their own currency. And so when you're dealing with Panama in terms of your foreign trade, you're really talking about US dollars as the transaction currency. Now, in the managed float concept that we talked about, those countries have made certain agreement in terms of making sure that their currency is stabilized. So for example, in case of China, they allow China RMB to move plus or minus 2% over a 6-month period. And if that currency is moving significantly more than that, what China would do is try to reestablish that peg in terms of how they're going to change that currency value. And of course, as you probably have seen that in the news that the United States government always complains that how China's currency is way undervalued, making their products so, in terms of competition wise, other countries are unable to compete with China because China artificially makes their currency value at a lower level, and giving disadvantage to countries like US and other euros and so forth. And last one being the crawling peg. The idea of a crawling peg is the amount is adjusted by small amount. This exchange rate changes based on certain indicators. Countries like Bolivia and Nicaragua uses those kind of management of the currency. So currencies are managed by these countries either using stabilized arrangement or crawling peg arrangement. And so it is important that when you do transaction with other country, understand the currency and understand how that currency changes, because that does affect in terms of how you manage your currency risk. Examples why you should do this. Generally speaking, in your normal day-to-day transaction, you're not going to see significant changes in currency value, but you can't depend on that. And sometimes what I call is the black swan event do occur. If you take, and I have two examples here, 1994, Mexican government decided that they were going to devalue their peso. At that point, I think it was 3,000 pesos to a dollar. And what they were going to do is convert 3,000 pesos down to $1. So they were going to change the currency from 3,000 pesos to a dollar to 1 peso to a dollar. And there was a significant decline in terms of what they were going to do. However, they didn't realize how market reacted when they made that announcement. The peso fell by 40%. So think about it. If you were receiving 1 peso, now that peso is worth only 60 cents. And so if you were receiving peso, all of a sudden 40% of the value of your peso just disappeared. And think about what that can do in terms of what your margins are. If your margins were only 10%, now you're looking at about 30% loss in your transactions that you did with Mexican country at that point. So another big crisis was Asia. And the big difference between Mexico versus Asia crisis was it started in one country, but it quickly spread to multiple countries. And as a result, particularly the countries like Korea, Thailand, and Indonesia, they suffered significantly. So I have a graph here in terms of how that currency changed from July down to the February of the following year, and how that currency value just dropped dramatically. During that time, many of the country's bonds were defaulted. Many of the companies could not pay the money. And of course, when they did pay you that money, particularly in case of Indonesian currency, it was worth only 20 cents on a dollar. And so you could have incurred significant loss if you had been doing transactions and had agreed to receive either Korean won or Indonesian rupiah or Thai baht, and you would have experienced large losses in your currency if you did not find a way to manage your currency. So it is important that you recognize and understand that currency value can change significantly in a very short time period. Okay. China, as we talked about it, how China has appreciated in value against the US dollar. However, you notice that China did not allow, and if you look at this currency between 2000 to 2005, China did not allow the currency to change. As other countries started to complain, they allowed Chinese currency to improve in value, and it went from a little less, more than 8 RMB to a dollar. Now it is slightly more than 6.5 RMB to a dollar in terms of the current exchange rate. But again, the government still, US government has continuously complained, and so has many of the other European countries, that this rate is highly lower than what it should be. China should really allow its currency to appreciate even more, which would allow other countries to be competitive with China. So let's talk about the foreign exchange market, because if you are dealing with currency, then you need to understand how this market works and what is it that they do in terms of the processes. So foreign exchange market, in terms of the people who actually do the transactions, are mostly foreign currency dealers and the banks. Banks make up about 60% of the transaction in the foreign currency market, whereas dealers make up about another 40%. This market is huge. On a daily base, somewhere in the range of more than $1 trillion worth of currency is traded. And so this changes in terms of currency between banks and dealers is a huge amount. One of the ways the banks deal with is what is called as a correspondent banking relationship. Without going into too much detail, what banks do is all the banks, there are about 100 international banks which have accounts with each other. So for example, let's say that the US has a customer and they need to buy £1,000,000, and there is a customer in UK, a bank, somebody needs to sell £1,000,000, and if there's a banking relationship, these two banks will offset these transactions with each other without having to do a significant amount of transactions, actual transactions. So in a correspondent banking relationship, they'll try to offset transactions against each other before deciding how much transaction actually needs to go into the marketplace. So the actual amount of transaction that occurs in the marketplace is a lot less than the true transaction that occurs as a result of the correspondent banking relationship. The idea is that the banks are trying to minimize the number of transactions and hence the cost of international trade. Most amount of trade that occurs instantaneous concept, like I want to buy $1 right now, they occur in what is called as the spot market. So in a spot market, you are currently buying or selling a currency. And every dealer who is willing to buy or sell the currency will quote two prices, what is called as the bid price and an ask price. Bid price is the price at which the dealer wants to buy the currency from you, and the ask price is the price at which the dealer is willing to sell you that particular currency. So in a spot trading, basically the currencies are traded based on the price which are quoted by the dealer, which is called bid price and ask price. When they give you this price, those prices are typically valid for anywhere between 15 to 20 seconds, because currency market changes so quickly, they will not give you a quote which will last longer, because they will change their quote once that time period has passed. Other ways of currency transaction occurs is the forward market. In a forward market, the idea is that I want to buy, let's say, 100,000 euro, but I don't want to buy for another month. What I can do is enter into an agreement today in terms of buying those pounds a month from today, and agree on a price at which I'm willing to buy that currency. So in a forward market, you're establishing the quantity and the rate at which this transaction is going to occur and the time period. The futures market is very much same as the futures market in grain, where you're agreeing to either buy or sell the currency specified. And so in that sense, it is pretty much similar to forward market. Only difference is that in a futures market, the amount of transaction that occurs are standardized. So like, for example, 1 million euro, you cannot do trade more than, you can do more than, but not less than 1 million euros. So each contract has a standardized value, whereas in a forward contract, you can customize exactly how much euro you're going to buy or sell. And then lastly, the option market, which are pretty much same as the option market on stocks and any other commodities, and that is you are buying an option to buy or sell a currency. So here you have an option, it's not an obligation, whereas in case of futures, it is an obligation. So you got to make sure you understand the difference between the futures versus option. Future is an obligation to buy or sell a currency, standardized amount at a specified price at a specified time, whereas option is the right to whether buy or sell. So you can choose not to buy or sell a currency within the given time period. Okay, and those are important things to understand, because those are the instruments which are used anytime you are trying to manage your exchange rate risk. Now, one thing about currency transaction that I don't have on the slide here, but just to let you know, that majority of the currency transaction occurs against 5 major currencies. Those are US dollars, euro, British pound, Japanese yen, and Australian dollars. So if I go and let's say that I'm a Thailand company and I'm doing transaction in Thai baht. Well, Thai baht is traded against either dollars, euro, yen, or British pound or Australian dollar. But if I am a Vietnamese firm and I want to do business with Thailand, then all of a sudden what you find out is that there is no direct quote between Thai baht and Vietnam dong. Vietnam's currency is named dong, D-O-N-G. And so I can't find the quote between the dong and the baht. And the only way you can find that is I would have to look at it, what is baht trading against US dollar? And what is dong trading against US dollars? And I can take those two quotes and have to cross them in order to make sure that I can understand what the relationship is between the dong and the baht. So keep in mind that currency transaction occurs largely with 5 major currencies. Okay. Now, question always becomes is, well, why does rate change? What is it that's causing this exchange rate to change? There are multiple reasons that can happen, but the 2 major reason is relative value of inflation and or interest rates, and relative strength of economy and growth and stability of the economy. So in the area of relative inflation rate, if the inflation rate, let's say in India is 10% and US is only 1%, what you would find is that the price of the goods and services will change by that amount in the future. And those two products are no longer. So when you think about it, a pair of shoe is a pair of shoe. It used to cost 100 rupees in India, $100 in US. So there should be a relationship of 1-to-1, but that shoe costs now $110 in rupees in India and only 101 rupees in US. Then what has happened is that the Indian market, the rupees is worth less because it's costing more. And so what that would do is cause the change in the value of the currency. So I'll often talk about in terms of when somebody says, gee, you know, I mean, I remember when I left India, I came here to the United States with $7 because that was the maximum allowed currency transaction at that time for an individual. And I had to spend, in order to buy $7, I had to spend about 50 rupees. Today, if I have to buy $7, I have to spend 500 rupees. I mean, so literally the rate has changed 10 times because now 70 rupees is worth $1 as opposed to 7 rupees to $1, what used to be as the currency exchange rate. And again, a lot of that revolves around inflation rate as well as interest rate. So relative interest rate, think about it. You know, if let's say Mexico bank provides you 15% interest on their deposits. And in US, interest on our deposit is only 1%. So if the exchange rate didn't change, and if I had $100,000, why would I not invest in Mexico? So I go to Mexico, put my 100,000 in the bank. A year later, it should be worth 110,000 and bring it back to US. Had I left it in US, it would be worth only 101,000, given only 1% interest rate. Well, market doesn't allow that, because if you do that, what would happen is everybody will take their dollars and go to Mexico, and there will be a huge shortage of dollars in US and huge surplus of dollars in Mexico, because everybody is going to Mexico to invest. And so what that would do is force the change in terms of the supply and demand for dollars and pesos, causing that currency rate to change. Okay, so currency will bring, in terms of the relative value of purchasing, in inflation and interest rate, back to what is called as a parity relationship. So from the theoretical point of view, there is a purchase price parity. One of the things that, if for the purpose of fun, if you want to ever look at it, is look at a Big Mac index. Literally, there is an index somebody has created where they look at the price of Big Mac in every country, and then see how that price of the Big Mac is changing, allowing you to see how the purchase price or the inflation is changing in every country, and how that would cause the relationship between their currency values. So it's kind of just looking at it, kind of this complex concept in a fun way. Relative economic growth and stability. People like to hold dollars. There is a reason why number of people in number of different countries rather have their money in dollars. The reason being, US economy is stable. They provide stable growth, and we have much better political stability. Whereas if I'm going in other countries, such as China, the political stability is at question. Same thing is true in Hong Kong. You find a lot of people in Hong Kong invest their money either in Canada, in Australia, or in US, because those are the three countries they consider to be stable, and they consider to have economic freedom. And so this is all because the behavior caused as a result of the political and economic environment of those countries. So you got to understand in terms of how that also would eventually impact the value of their currency. Okay. Now, from currency transaction point of view, when and where are currency transacted? This is a graph of the volume of transaction. Okay. Keep in mind, this is the volume, not in terms of, this is in terms of the time of the day. So if you look at this, the time of the day when majority of the transaction occurs is somewhere between 7 to 9 at 11, and also between 1 to 5. The reason for that is that when you look at what happens between US, Europe, and Asia, when people in Asia are asleep, we in US are doing business. When we are asleep, people in Asia are awake and doing business. The only continent which has common time frame of business between both sides is Europe, particularly London. So London is awake and doing business when US is awake and doing business. So for example, 1 o'clock in the afternoon is the lunch hour. I mean, so when you look at here, this is the lunch hour in London, and that's where the transaction goes down. Then 1 o'clock, America is coming in. Everybody's waking up when it's 1 o'clock in the afternoon in London. Everybody in US is waking up, and all the transactions which are coming from US are occurring. Whereas here, this is the time frame when people in Asia are, functioning, and this is the afternoon of Asia, and this is the morning of US. Whereas you take either time period to the end, either America is sleeping or Asia is sleeping. So this time period reflects when London is awake with either America or London is awake with Asia. So the largest amount of currency transaction occurs in London. London is the biggest international exchange market than any other market. And the sole reason for that is God gave them the location, allowing them a time frame, which is business time frame with both sides of the globe in terms of Asia and US. Okay, so that's all this graph is presenting, is just to give you an idea as to why there's so much transaction in London for foreign currency compared to any other place. Okay, now one thing you also have to understand is how currencies are quoted when you're doing transaction. It is always quoted as how many dollars per unit of foreign currency. Okay, so if I'm dealing with Japanese, how many dollars would one Japanese yen buy or sell? And that's what's called as a direct quote. That's the way currencies are always quoted, is number of dollars per unit of foreign currency. For understanding purposes, however, particularly for people who are not trading in foreign currency all the time, that just confuses everybody. Because we in America would prefer to know, if I have my $1, how many units of foreign currency am I going to buy? Well, that's just not the way currency are quoted. So newspapers and others will translate those into number of units of foreign currency per dollar, but that is not the way currencies are traded in foreign market. Okay, so understand that while we prefer indirect quote, which is number of units of foreign currency per dollar, that's our preferred approach because we understand it better, does not mean that's the way currency are traded. So for purpose of my understanding, for purpose of my computation, so if I'm creating my invoice, and what I know is I want $10 per unit of my product. So I want to know how many units of foreign currency do I have to price before I can tell them whether how many dongs am I going to ask you if I'm dealing with Vietnam, or how many Thai bahts am I going to ask you if I'm dealing with Thailand. Only if I know how many Thai baht equals $1, or how many Vietnamese dong equals $1, or how many Indian rupees equals $1. And that's the way our brain is wired, and that's the way we think. So always take the quote which is in the market. If you inverse it, it tells you how many units of foreign currency you're going to get for every dollar. Okay, so direct quote is the way currencies are traded in the market. That's the way they are quoted in the market. But for the purpose of our understanding and the way our brain is wired, we in the US would prefer indirect quote, which is the inverse of the direct quote. Okay. And of course, on the bid and the ask price, important part is to understand that the difference between the bid price and the ask price is basically dealer's commission. Dealer doesn't carry that inventory without earning some profit, but at the same time, you also have to understand that that dealer is taking the risk for having to carry that currency. And so when you go, for example, at the airport, and if you ever look at the American Express window, because I'm going to Thailand and I need some Thai baht and try to do some transaction, a lot of you probably buy some of those currencies at airport. Worst thing you can do, because the bid and the ask spread at those windows are huge. You're losing tremendous amount of money. The best approach to really receive a foreign currency when you're traveling is to use your ATM at the bank over there, and at least what you get is a reasonable market rate. The other part you also have to understand is when I'm dealing with different countries, and if everything is translated in dollar term, what is the economy of US versus China versus Japan? You're going to see the numbers. So for example, this is the number that I have here for, I believe it is 2011. In 2011, US economy was about $15 trillion, whereas China economy was $7.32 trillion, and take India as $1.85 trillion. Now, instead of looking at it in dollar term, if you look at it from the purchasing power, how much does it buy concept, then China's economy from the purchasing power point of view was really worth $11.29 trillion, when in the US dollar trillion terms, it shows only $7.32. And the reason I put this graph up here is when you're doing transaction, you have to recognize the true size of the economy. And the true size of the economy should be based on your ability to buy and sell goods and services. And so when you look at the ability to buy goods and services in terms of how large economies are, adjusted for inflation and adjusted for purchasing power, it is hugely different. So for example, based on purchasing power, India in 2011 was the third largest economy in the world. But if you take it based on the just pure dollar, real term, India was the 10th largest economy. So from the perspective of your decision as to where you want to do transaction, which markets are you going to look for as you start to think about international trade and think about where you want to export, start examining the true value of the economy when you do this transaction.
Ashford,
Yes.
we have a question here. It says, what are some good sources to watch rate movement? This person is in particular, they're interested in the Japanese yen, the euro, and the pounds.
Yeah, you can watch any currency movements in the foreign exchange market. So if you go to International Monetary Fund, IMF provides you that data. IMF also gives you a lot of time series data in terms of how the exchange rate has moved. The Federal Reserve, US Federal Reserve, any of the Federal Reserve office, if you go and put foreign exchange, they'll give you that data. But if you want to know the current market, then just strictly go to Yahoo Finance or Google Finance and enter the foreign exchange market, and they'll provide you that information.
By the way, to the participants out there, apparently we had a little bit of a problem with the handouts, but we'll be sending them out by Friday after the last session. Thank you, Ashwin.
Okay, thank you. All right. Now let's understand, I talked about how in terms of the exchange rate risk management, you either going to use forwards or futures or different kind of hedging strategy. So I want to make sure that you understand those. So, I talked about what the futures market is, but I wanted to make sure and give you that definition in my slide. so that you have it in front of you, because this is something which always causes confusion. So it says futures contract is like a forward contract that it specifies a certain currency which will be exchanged for another currency at a specified time in the future at a price specified today. Okay, so recognize future contract and forward contract sounds the same, but there are a few differences, and the difference is futures contracts are standardized. You can't change the value of the contracts. They're highly standardized, and that's the way they trade, and there is a daily settlement. Well, what is a settlement? So if I agree to buy a futures contract or sell futures contract, I'm making a commitment. And that commitment requires that you have financial resources. And so every time the value changes, your obligation changes in terms, depending on whether you're a buyer or a seller. And so what futures contract requires is that your account value reflects your ability to settle the transaction. So they want to make sure it's just like a margin trading on stocks and bonds that you do here in the US in the stock market. Futures contract is pretty much similar in terms of requiring that you show the financial strength to be able to do the transaction, because futures contract is an obligation. Same way about option. What option is, it's a right, okay? It is not, keep in mind, it is not obligation. And often people ask me a question, well, why would I go through an option instead of a forward or a futures contract? So let's say that you made an agreement with somebody in London to sell them 100,000 pounds worth of goods. And you're expecting that 100,000 pounds in 6 months. Well, in 6 months, the price of the pound to dollar can change. If I enter into either a forward or a futures contract, I am obligated to deliver 100,000 pounds and receive dollars in exchange. Whereas in case of option, I have an option to deliver 100,000 pounds, but I am not obligated to do that. So if your transaction with the foreign buyer is not definite, and if you have not secured through letter of credit or other sources to receive that money, in case of a forward contract or a futures contract, you have an obligation. Whether your client gave you 100,000 pounds or not, you must deliver 100,000 pounds. Whereas in case of a put, it's like an insurance. I have an insurance. I may collect, I may not collect on that insurance. And so the idea is that if I am not guaranteed that money from my customer, then I may use options rather than futures, because if I don't get the money, one, I already am I'm in trouble because I don't have the money. And then now I have compounded that problem by needing to deliver 100,000 pounds, which I don't have. Whereas if I go into an option contract, I can always let my option expire, which is like saying my insurance is expired and I paid a premium for insurance, and that's all. And that's my only loss. So a lot of time people may use option, particularly when the receipt of money, foreign money, is not guaranteed. So it gives you the right, but not an obligation, to buy or sell a given quantity of currency, whichever the currency it is, in the future at a price that you're agreeing on today. So there are two types of option. Call option is the right to buy, and put option is the right to sell. So if I had foreign currency, I buy a call option, which is the right to buy US dollars by delivering foreign currency. Whereas in case of a put option, I'll be selling foreign currency to buy US dollar. So in one case, put option is a right to sell foreign currency. Call option you would buy as a right to buy US dollars. I just, in terms of how you would use call option or a put option. So keep in mind.
Ashwin,
Go ahead.
I have a question for you. So in the case of, ABC supply company selling a product to somewhere in India, for instance, and trying to offset any kind of currency fluctuation, is it the case that most of the times the instrument that would be used would be an option versus a forward contract?
Option, the difference between the option and the forward contract is forward contract, you're going to have currency.
Right.
And so I would use the forward contract if I know in advance that I have the currency. Okay. If the currency is guaranteed, then there's no reason why you would not use forward contract. I would use options when I am not sure that I may or may not get the currency. My client is not that financially strong. I have some doubts about client's ability to pay. Transaction may fail. It may not occur. So any kind of uncertainty about the transaction or the receipt of the currency, I would use options.
Got it.
Okay. Now, to manage foreign exchange exposure, of course, question is, what kind of foreign exchange exposure do I have? And so far, we're talking about transactions. So when you talk about foreign trade, that's a transaction exposure. But keep in mind that the foreign exchange rate risk occurs for a couple of other reasons besides just the foreign exchange transaction. And so I'm going to quickly go over those two, economic and operating. That's not where the emphasis is for this particular workshop, but I want to make sure that you're aware of that. In area of economic exposure, I could be an individual who deals nothing with any foreign country. I don't buy from foreign country. I don't sell to foreign country. Even if you are not doing that, you are exposed to exchange rate risk. Because keep in mind that you have other businesses who are competing with you. And these businesses could be working in other countries, or they could be sourcing from other countries. So if I have a competitor, I'm sourcing my goods and material from US, and I'm sourcing from US, and my competitor is sourcing from another country. And if that currency declined in value, his cost of material went down. And all of a sudden, now he can compete with me better because his cost is less than mine. So keep in mind that as long as you have competitors for whatever products and services you're buying or selling, you are faced with exchange rate risk. Okay. So economic exposure is faced by everybody as long as you have competitors. Operating exposures is something that happens because of the event that causes cost to go up. Suez Canal is a perfect example. Suez Canal was blocked for a number of days, and all of a sudden everybody faced the delay in their raw materials or delay in their goods and services they may have purchased, and that caused a lot of changes in terms of your cost of doing business. There was a time when there was an enormous shortage in shipping market in Asia due to Asian currency crisis, affected everybody because particularly the retailers, and their costs went up. So those are operating exposure. Anything that normal day-to-day operation is influenced as a result of the foreign market. You got to make sure supply chain management in the pandemic, Rudy particularly talks a lot about that in terms of how a lot of businesses got affected by that. So it's important that you understand what your operating risk is. And so there are the seminars that Rudy puts out on supply chain management, which talks about how you select low cost production or flexible sourcing policy, or making sure that you have more diversification of your market in terms of how many markets you do business in, so that one market doesn't influence you significantly. And from competition point of view, make sure that you're continuously innovating and differentiating your product against your competitors. And of course, lastly, the financial hedging is something you want to do, particularly for your transaction exposure. So let's talk about just the plain transaction exposure. We got limited time. We already talked about most of it, so I'm just going through the details. There are 4 different ways you can manage your transaction exposure: invoice currency, forward contract, money market, and futures and options. And I already talked about futures and options. So let's talk about the forward market. In a forward market, I'm an exporter. I'm going to sell my goods and services to my foreign customer, and my foreign customer is going to give me foreign currency sometime in the future. What then I would have to do is take my foreign currency. I can buy a forward contract which establishes today the price at which this transaction will occur, and hence guarantees the domestic currency, which is my US dollar, that I would receive in the future. Okay, so recognize what you're doing. You're selling to your foreign customer who is agreeing to pay you foreign currency. So what you're doing is going into the forward contract market, buying a forward contract to buy US dollars and sell foreign currency. Okay, and so you're receiving foreign currency in the future. You're agreeing to sell that foreign currency in the future at a set price by entering into this forward contract. So that's how forward market hedge works. What basically you're doing is just buying a forward contract to sell the foreign currency in exchange for the domestic currency. Okay. So money market hedge. So let's say that you are an American exporter. You sold 100,000 euro worth of shoes to a French customer. Your payment is due in 1 year. In US, interest rate is 7.1%. In euro, it's 5%. Remember what I said, exchange rate will change if interest rates are different in 2 countries. And right now, the spot market is I can get $1.25 for every euro. Okay, so if I'm receiving 100,000 euro, I'm looking at $125,000, basically my final outcome. Okay, so as an exporter, what I would do is go to the bank, Credit Expo, and borrow from that bank $95,238.10 euro. This 95,238.1 euro is nothing more than a 5% discounted value of 100,000 euro at 5% rate. Because think about it, if I borrow from this European bank 95,238.1 euro at 5% interest rate, I will owe that bank 100,000 euro. So I'm going to the bank, I'm borrowing that much money with an agreement to give that bank 100,000 euro, which is what I am expecting to receive from my foreign customer. I will take this money and go into the spot market, which is $1.25 for every euro. So this number of euros times $1.25 is what I would receive in US dollars. Okay, which is $119,047.62. Then what I do is deposit that money into the US bank, which is giving me 7.1% interest rates. Okay. A year later, that money will be worth $127,500. And I'll explain to you in a second why that is important. Okay, so as an exporter, I sold my shoes to my customer. My customer agrees to pay 100,000 in 1 year. So based on that 100,000, I decided to borrow this money, 95,238 euro. This bank, I will owe them 100,000 euros. So in 1 year, when my customer pays 100,000, I pay off my loan here. I take my euro, convert it to dollar, giving me 119,047. I deposit that in the bank, and I get 127,500 euro. Now, look at the difference between US rate and this. So if I take a dollar, invest in US, is $1.07, $100 would give me that. Whereas in Europe, it would give me 5. So this exchange rate, sorry, I don't have a way to write. If I take 125 and multiply that times 1.071, which is US rate, and divide by 1.05, then what you would find is that number comes out as 1.275, which is basically saying is that in 1 year, current exchange rate is $1.25 per euro will change to $1.275 per euro. That exchange rate is going to change. So if I did none of this and I received $100,000, 100,000 euros, exchange rate would have changed to 1.275, and I would have received $127,500 for my 100,000 euros. But there is no guarantee that would happen. So in a hedge situation, what I'm doing is borrowing money right now and bringing that money to US and investing in US and keeping it there. Keep in mind that the idea is I'm going to invest in the US until such point this 100,000 is received. And the reason you want to do that is, what if your customer didn't pay? I have in my bank account 127,500, which would allow me to buy 100,000 euro that I can pay off my borrowing. Okay, so that's why it's called hedge. I am not playing with the market. I'm just making sure that I'm converting the money into dollar now, keeping safe in the US bank until such point this transaction is recognized in my books as having received the cash. Okay. All right. Option. There are, I already told you about that. I can buy a call option on the dollar with a strike in euro, which means I'm going to sell euro to buy dollar. Or I can have a put option, which is selling euro and receive dollar. So those are the call and the put option for the same transaction, which is receiving 100,000 euro, allowing me to convert that. Okay. One of the other things that is important is the idea of netting, something you may or may not have to do. But if I do multiple transactions in foreign market, make sure, let's say that I am buying from Europe. I'm selling my customer Europe 100,000 euro worth. But I have also purchased 60,000 euro worth of goods. Then my net position in Europe is only 40,000, not 100,000. So I don't need to do transaction on 100,000 euro. I need to do transaction only on 40,000 euro, because what I'm going to do is take my 100,000 euro that I receive, I pay off my importer 60,000 that I owe them, and the difference is only the risk that I have that I'm going to manage. So idea of exposure netting is take all your exposures, net them out, and then look at what your net exposure is. Don't try to do hedge transaction for every single transaction. Okay, so There are other ways to hedge, which is invoice. Obviously, the best thing is invoice in dollar. If you have strength and your customer wants your goods and they're willing to pay you in dollar, you're just completely avoiding the risk. So hedging is one way done by invoicing currency. If not, what you can do is share the risk. You can try and talk to your customers in terms of splitting the transactions into dollar versus foreign currency and how much risk is owned by who. Of course, you can always, if you're dealing with multiple countries, you're diversifying your risk by taking a basket of currency. There is a market for the basket index, and you can deal with that index because now you're dealing with multiple currency. Idea of lead leg strategy is only when you have so many transactions. And if I know a currency is appreciating, I want my client to delay the payment to me, because then, his currency appreciates and I get more dollars. If my currency is depreciating, I want them to pay me early. And the way I can entice them to pay early is by offering them some kind of discount to pay early, so that you receive your money before the currency depreciates. And so those are strategies. You get into it when your foreign transaction volume increases significantly, that you got to start paying attention to some of those strategies. I'll put those up there just for the purpose of in case you get into that. If your volume of transaction is minimal, not everybody necessarily agrees that hedging is worthwhile. It's a matter of which country are you dealing with, how volatile is that country, and what is your real currency risk. If you're dealing with countries which are extremely stable for a long period of time and you don't see any risk in change, then the amount of transaction and difficulty of managing the exchange rate risk could be such that you may choose not to hedge. Again, think about that. Keep in mind, of course, you're doing all of this through your bank. Your bank is the one going to help you in terms of managing your exchange rate needs, whether you're using forward contracts or options or whatever. So your degree of involvement is what dictates. The countries that you're dealing with also dictates what you want to do and assess as to how much is your risk. And the higher the risk, the more you want to pay attention to your foreign exchange risk management. Okay. And to end with, this is the view I used to wake up to and look at every day. For about a little more than 5 years, I lived in Hong Kong. I had left Arkansas, moved to Hong Kong in year 2007, and I returned back to Arkansas in October of 2012. And this is really what Hong Kong looked like from my house, or from my apartment, I should say. Hong Kong is a mountain, and I used to live in the middle of the mountain. So, for example, this building right here, which was on one of the Superman movie, is a 85, 90-story building. But it looks like, that I'm higher than that because I live in the middle of the mountain. So the base of my mountain where I lived would be like 50th story at the harbor level. As a matter of fact, this building right here is 50-story building, and I'm looking down on that building. And that was also my office building. That's where my office was when I worked in Hong Kong.
Yeah, Ashwin, thanks so much, man. This has been great. Hey, I wanted to let you know that one of our deck members, William Burgess, made a comment here. He says, we've been lucky enough to both export and import. In case like this, we have a euro-denominated account. We accept payment in euro and make payment in euro, and we avoid losses due to currency conversion and avoid much of the risk associated with currency fluctuations. So, the whole point of this webinar course is not to make you, experts in currency exchange and hedging and forward contracts. It's a really complicated topic, but it's to make you aware that these concepts exist and that there are instruments, vehicles out there to be able to take foreign currency in your transactions and to mitigate the risk as much as possible. And these are just some of the concepts that Ashvin has highlighted for us and that William commented on that can be used to be able to mitigate as much of that risk as possible. So don't shy away from doing a transaction in a foreign currency, because there are ways to mitigate the risk significantly. Ashvin, any last comment?
No, I'd say, William, thank you for, because I know you do a lot of transactions in foreign market and deal in a number of foreign market, and indicating what you do and what I've just stated in terms of the foundations of being aware of it, how important it is, because you want to deal in the foreign market. You don't shy away from the foreign market because of exchange rate risk. It's just that there are ways to manage the exchange rate risk, so don't be afraid of it.
Absolutely. Well, very good. Ashvin, thanks again. This has been great information. Ladies and gentlemen, we did have a little bit of a problem with the handouts, but we're going to be sending them out at the end of the 4-part series. Let me see here. Let me be sure to remind. Yeah, the last thing that I want to comment on is that there is going to be one more, the 4th session, having to do with private insurance for mitigating your risk, right? This is what this has all been about, these 4 sessions. And then the PowerPoints for all 4 sessions will be going out on Friday. Thanks again for being with us today. And should you have any questions of Dr. Vivikar, there's his both his phone number and his email address. There is the email address for Heidi, who runs this whole operation for us, and as well as myself. I'm the chairman of the Arkansas District Export Council. Please feel free to contact us and let us know if you have any questions or if we can be of service. Thank you again.